The FOMC raised our policy interest rate by 75 basis points, and we can. The FOMC raised our policy interest rate by 75 basis points, and we can. Increases will be appropriate. We are moving our. Increases will be appropriate. We are moving our that will be inflation to. Require maintaining a restrictive stance of policy for some time. We will require maintaining a restrictive stance of policy for some time, fully reviewing economic development. More to say about today's monetary policy actions after briefly reviewing economic development. It has slowed significantly. Page rose. It has slowed significantly. Page rose change so far this year. Indicators point to modest action. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. It can significantly reflecting lower real disposable income and tighter financial conditions. It can significantly largely reflecting higher mortgage rates. Higher interest growth on business fixed investment. Extremely tight year low, job vacancies still very high, and wage growth elevated. Jobs still very high, and wage growth elevated. Job gains rising by an average of 289,000 jobs per month over August and September. Although vacancies have moved below their highs over August and September. Although vacancies have moved below their highs, with demand substantially exceeding the supply of available workers. Anticipation goal of 2%. PCE prices rose, supporting the volatile food and energy categories. Core PCE prices rose, supporting the volatile food and energy categories. Core PCE price 0.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional pressure on the nation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The bout of high inflation continues, the greater the chance that expectations will become entrenched. The Fed's monetary policy is guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship. To meet the higher costs of essentials like food, housing, and transport. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. In the process of significantly reducing the size of our balance sheet, which at today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. Process of significantly reducing the size of our balance sheet, which basis points. Process of significantly reducing the size of our balance sheet, which action we've raised interest rates by 3 3/4 percentage points. Anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation 2% over time. To return inflation 2% over time. Have tightened significantly in response to our policy actions, and we are seeing the effect of demand in the most of the economy, such as housing. It will take time for the full effects of monetary restraint to be realized, especially on inflation. Why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And since our last meeting, quality of incoming data and their implications for the outlook for economic activity and inflation, we will continue to make our meeting by being as clearly as possible. Quality of incoming data and their implications for the outlook for economic activity and inflation, we will continue to make our meeting by being as clearly as possible. Taking forceful steps to moderate demand and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained of below-trend growth and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained of below-trend growth to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly at early. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The Fed. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The Fed will achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between and let's say the December seed with independent of that data given the lagged effects?
Following the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to our 2% or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to our 2%. We'll take into account the full range of analysis and data that bear on that tightening is actually happening on the real economy and on inflation. We rates, for example, all across the yield. For example, all across the yield. For example, all across the yield.
Out there about whether this means you're going to slow another 75 basis. Tons of confusion out there about whether this means you're going to slow another 75 basis point increase.
So what I want to do is put that question of pace in the broader is put that question of pace in the broader how high to raise our policy rate, and the third will be eventually how long to remain it. On the first question, how high to raise our policy rate, and the third will be eventually how long to remain it. On the first question, 0.75% since March, admittedly from a base of 0. It's a historic, given the persistence and strength in inflation and the low we started. Persistence and strength in inflation and the low we started. Is how I'll talk more about that. We think now is how I'll talk more about that. We think now is how I'll talk more about that. We think there's some ground to cover, but before we meet that test, and that's and as I mentioned, and incoming data between the meetings, both the strong labor market report, but particularly that we may ultimately move to higher levels. September meeting. That level is, we're going to find between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of monetary policy with which monetary policy affects economic activity and inflation. So I would say come closer to that level, move more. Speed becomes less important questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. It is likely we'll have a discussion about this at the next meeting. To be clear, let me say again, the question of moderate the pace of increases. To be clear, let me say again, the question of moderate the pace of increases is now much less important than rates and how is now much less important than rates and how keep monetary focus.
If I could. Result.
Well, I think I'm pleased as we have. I don't think. Well, I think I'm pleased as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above. I think that is too tight, given that inflation still runs well above. I think that the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And as I mentioned, we'll said again, move too fast. I think it's been good and a successful program. We still think there's a need for ongoing rate increases, and some ground left to cover here, and cover will. Some ground left to cover here, and cover will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, inflation on a 3 or 6 month annualized basis and on a 12-month in the high 4 to bring inflation that you are imparting enough restraint to bring inflation.
So this is the question, right? And I would say there are a range of views on principal view, but I would think you put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all occur for them, credit spreads are larger. So borrowing rate at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all occur for them, credit spreads are larger. So borrowing rate, I'd put some weight on it, but I wouldn't say it's something that will dominate.
Follow up. What is your best assessment or the staff's best assessment?
I'm going to look at.
If I could follow up, what is your best assessment or the staff's best assessment rate of underlying?
Specific number for you that look at that. And I mean, one way to look at it is it's a pretty stationary runs above pretty stationary runs above that level for sure, substantially above for some time. You'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I wonder, do you see any evidence at this stage that inflation?
So I guess I would by pointing, so if is inflation becoming entrenched? So I guess I would by pointing, so if at the middle move now back down, that's one piece of data. At the middle move now back down, that's one piece of data. The other thing I would say is that the longer we into this of high inflation, and thing I would say is that the longer we into this of high inflation, and ending at what point it becomes entrenched. We need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and underground it behind us. That's what we need to do, and what we're strong.
Hi, Chair Powell. Thank you for taking our questions. Rachel, Washington Post. The statement. Hi, Chair Powell. Thank you for taking our questions. Rachel, Washington Post. The statement for even a year and where you would expect it to show up in different parts of the economy.
Yeah, so it's only for a long time thought that monetary policy works. It's only for a long time thought that monetary policy works economic, and then perhaps later than that even on inflation. So that's been the thinking for a long time. Lags out to be fairly long. There's newer literature that says it's shorter. And, the truth is we don't have a lot of in what is now the modern economy. It's shorter. And, the truth is we don't have a lot of in what is now the modern economy. The difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Financial conditions were well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions then policy, because the markets are thinking what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing would say it's highly uncertain. And so from a risk management standpoint, we do need to be irresponsible. It's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint. But, if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of failing to tighten enough, or we want to be sure that we don't make the mistake of failing to tighten enough or
Put into those lag effects than they would have been after previous rate hikes.
So I think as we move now and policy be restrictive, it'll be appropriate now to be thinking more and policy be restrictive. It'll be appropriate now to be thinking more and policy be restrictive. It'll be appropriate now to be thinking more about life. Of course, we think about of monetary policy, but we will be thinking about them, but because it's appropriate to do so. Let me say this: it is very premature considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write.
Thanks, Chair Powell. Neil Orsios. Thanks, Chair Powell. Neil Orsios. As the clearest impact of your tightening so far has been on housing. These narrow in terms of. Look around the economy. The clearest impact of your tightening so far has been on housing. These narrow in terms of and channels lower than it used to be, and on housing in particular. Supply in ways that might cause problems down the road.
I don't know that the channels through which policy strong, very strong, of course, have have strong balance sheets. And so we go into the with excess demand market, as you can. Strong balance sheets. And so we go into the with excess demand market, as you can spend built up. So it may take time. It may take resolve. It may take patience. Strong spend built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. It may. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take. So sorry, was I getting? For inflation to come down. It'll take. So sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah. So, you know, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing houses at a faster rate, and in some parts of the country declining. Pandemic, as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, bidders, no condition. We all know the stories of how overheated the housing market was, prices going up, bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of from a financial stability standpoint, we didn't see supply and demand. We're well aware of from a financial stability standpoint, we didn't see housing credit was very carefully, much more carefully managed by the land. So it's a very different situation and doesn't present potential financial, doesn't appear to present we do understand financial, doesn't appear to present we do understand that that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw a signal from that. So both is slowing, and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about that?
We talk a lot about vague and other data, and unusual important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So unemployment, which is typically the single statistic at a 50-year low, 3.5. So unemployment, which is typically the single statistics at a 50-year low, 3.5. So I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level above the level that would be consistent. True with average hourly earnings you see. So I would call it a flattening out at a level above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity there. With the ECI reading this week, again, a mixed picture. The headline number was a disappointment, less of a decline. There's some rays of light in workers that did come down. The compensation did come down, but overall, though, inside the private sector workers, that did come down. The compensation did come down, but overall, though, job creation still exceeds, job creation still exceeds, job creation still exceeds, there would get where it. That's the picture. Do we see is happening? Maybe that's there, but it's not obvious to me because wages aren't coming down. Is happening? Maybe that's there, but it's not obvious to me because wages aren't coming down. Well, both ECI and average hourly earnings. We or real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a
As I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a
It has an effect on wages. I think that's always been the case. There's always forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. Story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, once you see it, we don't want to see it. We want wages to go. See it. We don't want to see it. We want wages to go sustain inflation. We can soften openings declining. We think there's room for that, but we won't know that'll.
That would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy. We're in very frequent contact with foreign counterparts. With our foreign counterparts. And I have one this weekend with many central bankers. Meetings and the rep that we have, and I have one this weekend with many central bankers. So we're in touch with all of them. So it's we're seeing China's having issues with the zero COVID policy, the war in Ukraine, and China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we're seeing strong dollar but we have it, and we take all of that into account. Here in the United States, we have a strong economy, an economy where inflation is PCE is running at 5.1% on a 12-month basis and sort of similar 6 and 9-month basis. Is running at 5.1% on a 12-month basis and sort of similar 6 and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States, a good thing for our economy for decades, hopefully, even though it may be difficult to get it to pay ends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides we serve for the long run.
If I could just follow up on that.
Don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channels affect them just at the margin. For the most part, food and energy prices, but the demand channels affect them just at the margin. The thing about the United States is that we also have strong as energy. In the United States, we supply with any parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is global. You're right, though. We don't, the price of oil is global. And, it's not something we can affect. By the actions that we take, though, we help, and it's not something we can affect. By the actions that we take, though, we help times when energy is part of the story of why inflation.
And so some senators like and so some senators like
we do risk time. We do risk. So, to beating yes. Undermining, very so. To beating yes. Yesterday, actually, we had a committee to on ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal and we've taken. I would just say we do understand our new. Our new program that is up now, and it was through that program that is up now, and it was through that we now have a central group here, disclosures, and also all of their trade anyone has to make was covered has to. Market. So it's a really, and I think we all
have an update on
ourselves to the highest stance problems.
do you have an update on
Ourselves to the highest stance problems.
do you have an update on
Their body general. Once that happens, I don't discuss it with the Inspector General. I don't discuss it with the Inspector General. So that's what he's doing.
Keith from Bloomberg. Earlier this year, you tell Bill Bloomberg. Earlier this year, you tell Bill that means that curve is only 2 basis. Said, quote, if it's inverted, that means that curve is only 2 basis.
Ones that people. You're right. Impurity. It's the ones that people. You're right. Impurity. It's the ones that people. Can be doing. Expect to come down. So if you're in a situation where the markets. That's what I would say.
If I could follow up, to going too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Interest rate. It's by 375 basis points. I would not. The cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So That isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that, what's the level we need to get to rates. And, I don't know what we'll do when we get there, by the way. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris. Rugaber.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay. But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to wage to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.